All right, let's talk about one of LIC's most popular policies out there, Jeevan Lakshya. We're going to break it down, demystify it, and really get into what it's all about. At its heart, it's meant to be a financial safety net for your family. So let's just dive right in and see how it all works.
You know, this is the big question, isn't it? It's really the question that sits at the very core of what the Jeevan Lakshya policy is trying to solve. It's built around one single powerful idea, making sure that those big dreams you have for your kids, well, they're looked after, no matter what life throws your way.
Okay, so you see all these technical terms, right? Participating, non-linked. What does that even mean in plain English? Well, participating is pretty cool. It just means your policy gets a slice of LIC's profits in the form of bonuses. And non-linked, that's a big one. It means your money isn't riding the roller coaster of the stock market. It's a more stable, traditional kind of plan. So really, it boils down to two things: protection for your family if you're gone, and a solid way to save if you're not. Simple as that. All right, first things first, let's talk about who this policy is actually for. What are the eligibility criteria?
So, looking at the numbers here, the entry age is pretty flexible. You can get in anytime from 18 right up to 50 years old. And the policy term? You've got options there too, from 13 to 25 years. The main rule is that it has to mature before you hit 65. As for the money side, the basic coverage starts at 2 lakh rupees, but there's technically no upper limit. Of course, that'll depend on LIC's underwriting rules.
Now this is a really interesting feature of this particular plan. Check this out. You actually stop paying premiums 3 years before the policy even ends. So let's say you take a 25-year policy. You're only going to be paying for 22 of those years. For the last 3 years, you're done with payments. But guess what? Your life cover is still fully active. Kind of nice, right?
Okay, so let's get to the big question. What actually happens at the end? Basically, there are 2 main paths this policy can take.
Think of it like a fork in the road. Path 1, you live through the whole policy term and you get what's called a maturity benefit. Path 2, the unthinkable happens. And in that case, your family gets a death benefit, which is actually designed in a very unique, multi-part way. Let's break down both of these scenarios.
So, let's say you complete the whole term. Awesome. What do you get? Well, you get your basic sum assured, that's the guaranteed part, but then, on top of that, you get the vested bonuses that have been adding up over the years. And if things go well, there might even be a final additional bonus. See? That's that participating feature we talked about earlier, paying off. Okay, now let's switch gears and talk about the death benefit. And honestly, this is where the Jeevan Lakshya Plan really stands out. It's not just about a one-time payout. It's designed as a complete support system for your family.
So here's how this unique 3-part payout works. It's brilliant, really. First, an annual income stream starts flowing to your family, right away. Second, and this is huge, they don't have to pay another rupee in premiums. The policy takes care of itself. And third, at the end of the original term, they still get a big lump sum payment. It's designed for both immediate and long-term needs.
Let's get into the nitty-gritty. That annual income? It's 10% of the basic sum assured paid every single year until the policy was supposed to end. The premium waiver? That's exactly what it sounds like. A huge financial burden lifted off their shoulders. And that final payout at the end? It's not just 100%, it's 110% of the basic sum assured, plus all the bonuses that kept growing even after the premium payment stopped. It's a really powerful combination.
Okay, moving on. Let's talk about the extras and flexibilities. You know, the optional riders in the loan facility. So you can also enhance your policy with what are called riders. Think of them like optional extras on a car. For a little bit more in premium, you can bolt on some extra protection to make your coverage even stronger.
And the main ones available for this plan are focused on accidents. You've got the Accidental Death and Disability Benefit Rider and the Accident Benefit Rider, both designed to give your family extra support if an accident occurs.
And what if you need cash in an emergency? Well, that's another bit of flexibility built in. After you've paid your premiums for just 1 full year, you can actually take out a loan against the policy. It's a handy way to get some liquidity without having to surrender the whole thing.
All right, let's get into the rules of the road. These are the key terms and conditions you'll want to know about.
Okay, 2 important time frames to keep in mind. First is the grace period. If you miss a payment, don't panic. You've got 30 days to catch up from most payment modes. But what if you miss that window and the policy lapses? Well, you still have a massive 5-year window to bring it back to life. You just have to pay the back premiums with a bit of interest, and your cover is back on track.
Okay, enough with the theory, right? Let's look at some actual numbers. I find a real-world example makes everything so much clearer.
So let's imagine our person. They're 35 years old, they take out a policy with a basic sum assured of 2 lakh rupees, and they choose a 25-year term. Pretty standard stuff.
So for that person, the annual premium works out to be about 9,535 rupees before taxes. And don't forget that special feature. They're only paying this for 22 years, not the full 25-year term.
So, fast forward 25 years. What's the potential payout? Well, the official illustrations give us 2 possible scenarios. If we assume a 4% per year return, the projected payout is around 2,35,000. Now, if the returns are more like 8% per year, that number jumps up to 3,80,000. But, and this is a really big but, you have to remember something very important.
And this is it. This is the official must-read disclaimer. The bonuses are not guaranteed. They completely depend on how LIC performs in the future. Those 4% and 8% numbers, they are just examples that the regulator makes them show. They're not a promise, not a floor, not a ceiling. The actual results could be different. It is super important to understand that.
So, let's wrap this up. What's the main takeaway? We're looking at a plan that really tries to do 2 things at once. Provide serious protection and a structured support system for your family, while also being a disciplined savings plan for your own long-term goals.
So, at the end of the day, the real question is for you. Is this specific blend, this powerful combination of long-term protection and very disciplined traditional savings, the right puzzle piece for your family's financial future? It's definitely something to think about. Thanks so much for joining me.